started here in a minute. All right, get going. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with my good friend Doug Hayron. Hey, Doug.
Happy Friday to you, Kirk. Good to be with you. And again, it's always nice to break away, have a nice conversation, and get away from the grind of other things. So I love our little weekly fun distraction. But I'm sorry I'm going to miss you for the next week or so. So hope you can live without me, Kirk. For those listening, I'll be off for I think the next one or two. So
as I say, Doug, I can't miss you if you don't go away.
That's right, exactly. So I'm just trying to make you remember exactly why you love me.
Yep. Well, cool. Well, happy pre-Memorial Day weekend to all of you. I'm excited because I'm done for the week after this. I'm taking the rest of the day off and going to enjoy the outside and before it rains on Sunday and Monday. But that's all right. Day off's a day off. So yeah, a lot going on in the markets, and we're going to talk about quite a bit of it today. But I did want to start the podcast with some really cool stuff that I learned yesterday. And most people haven't heard of this yet. I've talked to a lot of accountants, even they haven't heard of this yet. So you're getting your. I'm not burying the lead here. Let's put it that way. So apparently there was a court case, Kwong, KWONG versus the U.S., and it was over COVID-19 relief, disaster relief. And it's complicated, but basically the simple version is from any penalties and interest assessed between January 20th of 2020 and July 10th of 2023 are considered improperly charged under this ruling. So apparently Kwong won, and my understanding, I could be wrong, this is not tax advice. This is just something to talk to your tax professional about, because the people I've talked to said there's no way for them to even find all of their clients who have this affected. So you need to be the one to ask. Do not expect your accountant to do it. And this is not a reflection on them. This is just the fact that if they've got 500 people, they can't possibly find everybody who had interest and late fees. So if you paid any penalties, interest, late filing fees, anything like that from January 20th of 2020 and July 10th of 2023, you could be affected and you could get money back. Now, this is being appealed. So this is all my understanding. Like I said, I could be wrong. This is what I've been told so far. It's still new. It's still fresh. So most people aren't aware of this. So it could be that more information is coming out, but I just wanted to get it out there because the key is to talk to your accountant about this and get on the radar. And here's the reason. This court ruling was in the Kwong's favor, which is good for all of us. However, it's been appealed. Now, the appeal is most likely going to go beyond the window. You have until July 10th of this year because there's a 3-year window which you can change your tax returns. So if you're beyond that 3-year window, you can't apply for this. So there's a form you file. I think it's like IRS form 843 or whatever. But like I said, it's not tax advice. Talk to your accountant. But my understanding is this form will reserve your right. So once the appeal comes, finalized. So if the appeal's finalized and people get their money back, then this form apparently, to my understanding, will reserve your right to get that. If the appeal happens after July 10th and you don't file this, my understanding is you won't be, you won't get it. So talk to your accountant about it. Look this up online. There's some great summaries, KWONG versus US, and look it up. It'll give you a summary. And I'm just letting you know because this is really cool. Because if you file late, if you have penalties and interest, you can get some money back potentially. And I'm excited because I never file on time. So dealing with everybody else on my clients and making sure they file on time. So, it's common that accountants don't file on time and financial advisors, I don't, but it is what it is. So my point is look this up. I think you'll be happy that you did. If you don't file late, if you didn't get penalties during those years, then it won't impact you. According to the articles, they say about 10 million people will fall into this number. So if you're one of those people, Merry Christmas. Anyway, I just wanted to start off with that. But one of the things I did want to talk about today is a really important topic that nobody really cares about. And that topic is bonds. And the reason I'm talking about it is this. There are a number of things going on that people are very concerned about. Now, I think we've kind of mentioned it in passing in prior weeks. And I know this is a snoozer of a topic for most people, but I'm telling you, it's not in this case. Now, we've been in a interest rate environment which has been very weird in the last 5 or so years, or 6 since COVID, right? And what I have here is basically the yield curve from the last 3 years, okay, or 2.5 years. And each one of these is the yield curve. And I'm going to explain this for those of you who are audio viewers. I'll get to the point in a minute. On the left side of the x-axis, it is the maturity. So 1 month, 2 month, 3 month treasuries up to 1 year, 5 year, 10 year, 30 year. So this is what we call a yield curve, going from left to right. You want the yield curve to be going from the lower left to the upper right. That is a normal sloping yield curve. Now, as you can see here, that's not the case, and hasn't been the case for a while. But that is what we call a normal yield curve. You want the 30-year maturity, so like a 30-year CD or 30-year treasury. You want that yield to be higher than a 1 month. And the reason is if you're buying a treasury for 30 years, you're taking risk, assuming that you're going to sell out at some point. You're taking risk. The risk is the interest rates could go higher. If they go lower, it's fine. But they could go higher, which means you could effectively be either losing money or you're losing opportunity cost. So technically, your long-dated bond should give you a higher interest rate than short-dated. However, that hasn't been the case recently. It is now, but it wasn't 2023 and before. We had what we call an inverted yield curve. That's where the short end, like the 1 month, 3 month treasuries, are higher yield than like the 30. Now, what that suggests is that there's no incentive to take risk on the 30-year bond. You want to own the short term because you're getting a higher rate. And what ends up happening is banks don't make money if it's inverted because they're borrowing on the short end and they're lending on the long end. That's what they do. So if the short end's higher, the banks don't lend because they're losing money. There's no point. So now it is a positively sloping yield curve. It is a normal yield curve. It's not great, but it is better. Now, what I want to share is this. The interest rate yield curve today is the blue line. So it is a upwardly sloping line. However, what you need to keep in mind is that the 30 years or the 10 years, the 10 year is about 4.6, a little bit less than 4.6. The 20 year, 30 year is right around 5.2, 5.1, 5.2. So the challenge is when interest rates get to a certain point, the bond market gets a little squirrely. And by that, I mean, people are concerned. Now, prior to the war, interest rates were lower. Okay. Interest rates were, frankly, a lot lower. And I'm going to actually pull this up here and give me a second here. Okay. So if I pull this up here, we have, where is it? Let's see. Apologies to everyone. Okay. So prior to the war, so looking at February, call it 26th, the 30 year was somewhere right around 4.7. And all the rates were lower. Now, the expectation prior to the war was, yes, the economy was running a little bit hot, but oil prices were low. Trump was going to lower rates because that's just who he is, a real estate guy who wants lower rates. However, since the war has started, oil rates have gone higher, which means that inflation is going higher, commodity prices are going higher, and that means that goods and services to the consumer should be higher unless the companies eat that difference, which means that, Joe and Susie Public out there who are, working a job just to pay the bills, they're struggling because gas prices went from $2 up to $4 or whatever the numbers were, but it's a huge jump. that's money out of their pocket. That's money that they're not spending on other things. It's basically a tax. And so I have to heat the house. I have to buy, heating oil. That went up a ton. All these things that you're paying for, they go up, which means that's less money in your pocket to pay for things you want to do and other things. So the point being is the Treasury market is at a place right now where it's a little bit concerning. And the market is very concerned about where Treasuries are. They're concerned that the 30-year is above 5, which is not as concerning, but they're concerned about the 10-year being high, and mortgage rates are high. I think mortgage rates went from 6 up to 6.3. You're getting close to a 4.6 on a 10-year. 10-year is really the rate that people watch, but the 30-year is also important. So the concern is that if rates start to go higher, then the stock market will start to melt down. The cost of everything go up. The cost of companies to borrow go up. All these things happen because we have higher inflation. So the concern is that maybe the Fed starts raising rates. If that happens, there's a big concern there, because the Fed was in a sort of an easing cycle. And now if they start raising rates, well, now we're in a raising cycle. I don't know if you all remember what happened in 2022, but it wasn't pretty. And that's when, 30-year treasuries lost 50% of their value. That's when, the stock market went down 30% or so, and the bond market went down a lot. That's basically anything but cash lost money. That was a year where everything correlated. Now, the concern is that we're in an environment where things are correlated right now. So stocks go up, bonds go up, stocks go down, bonds go down. That's not what we were taught in our textbooks in economics, where there's an inverse relationship. It should be the inverse. No, they are correlated. They're doing the same thing, which means that bonds are not protecting you right now. Now, I'm not saying, run out of bonds. I'm just saying that if you expect bonds to buffer the returns if the market goes down, that's not going to happen because of the correlations, just the way they're correlated. So we're in this period where everybody's happy and excited about, certain parts of the stock market doing well. If you've been listening to the show for the last few weeks, that is not necessarily the case. There is one certain area that's doing well. The rest are just kind of basically biding time, and that area is semiconductors. But the rest of the markets are just kind of going sideways. So if you're looking at your portfolios, the thing to understand is this. The markets are very flat right now. I'll call it flat. Yes, the indexes are higher because of the semis, because they're like 30% of the index. I think it's like technology is 30%, but software is coming up a little bit. But anyway, there's one area in the market that's taken it's pulling all the weight. And because it's so narrow focused, it's a very unstable market. Now, that doesn't mean it's not going to go higher. I'm just saying that as an investor, I'd be a little bit more cautious because the rest of the market is not picking up slack. The rest of the market is just hanging out. Now, if interest rates start to go higher, and we're at this level, especially with like the 20, 30-year or the 10-year, we're at this level where if interest rates start to go higher, it's going to be a real problem. And now there's two scenarios that play out from here. One scenario is that inflation takes hold and interest rates go higher, which means that bonds will start to lose money and equities will probably start to lose money as well. Now, if we have inflation, prolonged inflation, because right now it's only been like 2.5 months. If we have prolonged inflation and we have higher interest rates, what that means is the economy is probably going to slow down. Now, if the economy slows down, that will start to correct interest rates because there won't be inflation, because people won't be buying as much. So there is a corrective cycle in here, which, most people think they just take a thought. So they'll see something like this and like, oh my God, treasuries they're gonna crash, and oh my God, this is the end of the world. People always go to the extremes, right? You think of AI, it's going to be either utopia, it's going to be Star Trek, or it's going to be dystopia, it's going to be Terminator. Well, it's probably going to be neither of those things. But our minds tend to go to the extremes. They tend to go to one extreme or the other. So in this, a lot of people are talking, oh, it's the end of the world, interest rates are going to go up, oh my God, inflation, hyperinflation is going to be terrible. No, It's probably not going to happen. Also, people say, "Oh my God, it's going to be great," and then the semiconductors go to the moon. Yeah, that's probably also not going to happen. So there's going to be something in between. The markets tend to balance each other out, right? It's supply and demand. So if you have high inflation, that's going to slow the economy down. If it slows the economy down, it slows down inflation, right? And so there is some balancing mechanism that's going on there. Now, the big question is, how long is this war going to go on? That's the real question. And if it goes on until election time, I think we're going to have higher inflation, definitely. If it ends soon, then all of this, like we talked about before, this all just kind of goes away. And yeah, there'll be some bumpy roads next quarter in the earnings, but otherwise, people get over it. The market will get over it pretty quickly, just for reference. But the problem is everyone believes that this will be over tomorrow because Trump is so good at PR, at letting people know, oh, we just got a final draft. I don't know if that's true or not. Last week, he was talking about bombing people, and now it's in a final draft. I don't believe a word he says, nor do I believe a word the media says, nor anybody else, right? They're clearly managing people's expectations of what's going on. I don't think you have anything to lose by sitting on the sidelines here. I don't think you do. With exception of semis and like certain energy stocks, sitting on the sidelines is fine. There's nothing to lose. I think if the war ends tomorrow, I think there'll be plenty of opportunity in the market to make money. I just think right now we're at this place where there are times in the market where there's easy money and there are times where it's hard money. And right now it's hard money, which means that a handful of stocks are doing all the heavy lifting. There's a lot more risk in those stocks. Everything else is kind of biding time. It's kind of a flat market, and it's really hard to make money in a flat market. And people who try tend to lose money pretty quickly. So you just have to be very nimble. And, if you're a dividend investor, you'd be fine. But, if you're investing hoping for appreciation, it's probably not going to be what you saw last year. And this is what I'm telling everybody. It's like we expect a flat volatile year. We'll see some big ups, some big downs, but it'll probably be very flat overall until Q4, in which case we expect to see some upside. But really, it's just sometimes the best thing to do is you're getting 4% in cash for short-term treasuries. That's not bad for like sitting around for a few months. That's better than nothing. It's better than losing money. So just something to think about. But I wanted to start that off because interest rates are coming into the public sphere conversation so much, and I don't think a lot of people understand why. But that's why it's important to understand it, right? It shouldn't change your perspective too much, other than the fact that if you understand it, it will help you put things into perspective. I'm going to leave one more chart here. I'm going to hand it back to Doug. This is a chart of bonds, sovereign bonds for 9 different countries, including the US. Okay. There's the 10-year and then there's 10-year forward. But if you really, what you want to look at is look at all of these interest rates of all these countries. They're all going up. Okay. Switzerland's still kind of low, but every single one of them is going up. Germany's going up. Japan's going up. Italy's going up. UK is going up. France is going up. Australia is going up. Canada's going up. Switzerland's coming up a little bit, but Switzerland's a little bit unique. And the US. So interest rates are rising across the board for everybody. And this wasn't just the war. This was prior to that, right? In Japan being Japan and France and Australia kind of being one of the worst offenders. Germany's not great. UK is not great. Actually, they're all not great. So the point is once you're seeing this should tell you something, that there's inflation in other countries. Now, if there's inflation in other countries, what does that mean? Well, if you're not aware of it, then you could get sideswiped by a whole bunch of different things. So I want you to keep in mind, it's not just the US, there's stuff going on in other countries, and this could be a problem for many countries. But right now, I'd be very, very careful about what you're doing with bonds, because if interest rates are going up, that means bond prices are going down, which means you're losing money. So if you're going to invest in bonds, stay in the short end, because you're not losing in the short end, right? It just, you buy 30-year treasury, it matures, you get your money, and it keeps rolling over. So you're not really losing money with that because it just continues to roll over. But if you're buying long dated bonds, just be very, very careful, because that that could cause you to lose a little bit or even a lot of money if interest rates keep climbing like they are. So, Doug, what are you seeing this week?
Well, I appreciate that you start off on bonds, because I think that's a really telling area. We've talked about that before. I mean, stock market tells you where the emotions are, and the bonds tell you where the reality is. I think that right now we have, and I said this last week, I think we're facing a significant level of conflict. And I am not talking about what we're doing in Iran or the Middle East. I am talking about the data that's coming out there. The consumer has been relatively resilient so far. We are still seeing that delinquencies, although they have spiked in certain areas like student loans, they have not necessarily taken off heavily. And we're seeing them kind of stabilize, even though credit card debt is going up. The liquidity is showing that people are still able to absorb that. Consumers are adapting; they are not thriving. There's significant more credit stress. We are starting to see more selective spending, which means that they are surviving inflation. That is a positive, at least for now, as long as the liquidity machine can still be injecting that in. But we are seeing that they just missed on. We've got stocks are stable, record high. The economy is diverging from that, and the market is pricing in that liquidity that's coming. The economy is really living in the reality of that. We just got a new housing report that missed. I don't think that should be a surprise to anyone, given the way we've been talking the last couple of weeks, given the fact that they aren't moving. What I thought was interesting is they just came out with some new information. Beset took a little bit of heat. It was kind of a little bit of a disconnected take when he talked. I can't remember, it was a month or so ago. At least when it came out, he was being interviewed. He said, everybody out there's got multiple homes, and of course the reality is they don't have multiple homes. But they did show that at least in the aging community, the baby boomers, being a large portion of that, there is a fairly high percentage, between around 15 to 20% do have multiple homes, and so he wasn't wrong. It's just a very narrow focused take, but that of course is not a great sign for necessarily going forward when it comes to where the housing market is going to go, and why we are still stuck in a situation where housing isn't moving. And housing is a critical component to future growth. It is the ability for younger families to get started, to begin to make longer term and financial decisions. If they feel that they can't begin to raise their families, they can't be able to get into that that area. If houses are moving, if they either can't buy in, or those that have it are stuck, that is definitely going a tremendous headwind for the entire economy. And what's really showing a sign there is that we're now starting to see mortgage rates go back up. That's going to make things more expensive. Houses are not moving. We're not seeing the transactions, although we are seeing them in certain areas. And there's data showing that for an equilibrium to occur, we really need about a 30-40% decline in prices in certain markets, just to be able to get to where the current interest rates that are being charged on, for mortgage rates versus valuation of that actual asset needs to be to come back into equilibrium. And so, that's going to continue to create some significant challenges out there in that aspect of the world. And of course, that is related to bonds. Now let's look at a couple of other details on the bond side of things. Is that we are now seeing that American consumers, again, 7+% mortgage rates, 4+% inflation. Ultimately, since 2020, a 30% loss in the purchasing power of the U.S. dollar. So that makes the second half of 2026 very, very interesting. We are also seeing some data that's come out, that's showing that China has been fairly aggressively. If you go back to where 2020, China's holding of U.S. Treasuries that was roughly around $1.1 trillion. They have been selling them off, and it started in 2022. Very heavily into 2023, but it is accelerated again into 2026, kind of stabilized there between 2023 and 2025. But they have gone from a peak in 2014, around $1.2 trillion in U.S. Treasury holdings, to kind of holding steady relatively between, like I said, between 1 and 1.2. They're now down to only about, $650 billion in treasury holdings. So there is an acceleration of sell-off, and again, this doesn't do really well with the repo. Again, when we put out new bonds, we need buyers. And if the rest of the world right now, for whatever reason, is a net seller, that puts a lot more pressure on those yields. The 30-year note has risen to 5.18%. That is the highest the 30-year note has been since July of 2007. I don't know if anybody recalls, 2007 wasn't exactly a great time. It was actually decent until August of 2007, and then things got interestingly worse from August 2007 minus a slight recovery into 2008. I don't know. Go do your research, kids. It wasn't a great time from 2008 on. And that's not, that doesn't bode well for public debt. We're looking at net interest expense accounting for 20% of total tax revenues, the highest level since the 90s, according to the Congressional Budget Office. The future is projected to rise to 29% of total tax revenues by 2035. So that's, again, there's no relief in sight there. Ultimately, too, we have to look at, again, what's going on outside of just U.S. debt. U.S. bond yields, Japanese bond yields. We talked about them from time to time. Watching Japan is certainly a very interesting, and a very telling data on a global scale. There is some data, again, to be read with a little bit of more context, but every time the spread between 30-year Japanese government bonds and 30-year U.S. Treasuries started to shrink sharply, there has been a major financial crisis somewhere in line with that. And so 2008 was a sharp decline in with the global financial crisis, European debt crisis of 2012 and 2020. We are actually starting to see that again. At this time, we're not necessarily seeing data that the U.S. On the U.S. Treasuries rising. They're not falling. Before, a lot of it was U.S. Treasuries falling. Japan fell, but then it narrowed. This time, they're both rising sharply. And again, bonds will tell you where the fear is, and the fact that they're both rising sharply. It's not a great scenario for the U.S. debt market. Again, with China's holdings dropping to $693 billion. These are levels we haven't seen since the 2008 crash. As I said, down from 1.3, with both bond yields for Japan and the U.S. Increasing. It's not a great sign for the future of the markets. It's not a great sign for future of inflation. We're also starting to see consumers get a lot more pressed. Like I said, I've talked about this before. They're still paying their mortgages. They're still paying a lot of things on time. But one area that they're not is student loan repayment. We've actually seen 71% of loans that are student loans are not being paid right now. And now that's not necessarily because they're in default. 10% is in forbearance. 3% is in deferment, grace, etc. But that was in 2025. 1 year later, it's risen by another 5% that are not paying, and those that are paying is only about 25%. So again, that debt is spiking, but it is not being covered. And a great point I saw recently is that with CPI inflation on track to exceed 5% as early as this year. Over the last 6 months, CPI inflation averaging an additional 0.4% on a month-to-month basis, with the March and April readings as high as 0.9 and 0.6 respectively. If that trend continues, they are, this is from Bank of America's Global Investment Strategy, put out by Bloomberg. We're looking at, over 5%, fairly, again, at the rate it's going, that will happen. And of course, that can be adjusted. Inflation tends to, although the stagflation in the 70s tends to pull back when, demand and money supply, limit, which again, a sharp pullback in the economy could create. But again, that creates its other problems. I think, again, not just looking at the bond yields, I think we have to look really quickly, and then I'll turn it back to you. We have to look at what this means for for what's going on in the markets. Okay. There's this thing that some people, again, if you're older, you remember Greenspan saying irrational exuberance. And this question, what is irrational exuberance? It's when the markets just keep going up and up longer than it seems like they should, given the fundamentals underneath. We've had 29 trading days where the index moved opposite to the overall market breadth. That's the most through the first 93 trading sessions of any year on record. In other words, on many days when the S&P 500 closed higher, more stocks actually finished negative. We have two stocks that are predominantly driving the market right now. We've got NVIDIA and we've got Apple. They represent 15% of the S&P 500. That is more concentrated than ever. And there's something I think you have to watch and listen a little bit of what's going on right now. But there was some things in the news this week about potential pulling back on AI investment. It continues to come out because it is absolutely, the amount of spend on it is significantly draining the bottom line, especially a lot of the AI leading firms. If you look forward, Microsoft is pulling back on a lot of its investment, which again, they have really lagged in this area. You've got Google. There's some data coming out about how Google, they're using AI, making tremendous profits right now, but again at the expense of a lot of their core revenue for the future, because right now they're using a lot of AI as basically glorified web search, and they're giving you the summaries, which they've shown tremendous double-digit drops across a number of different websites out there. As again, they get paid for those clicks. Consumers now are getting the AI summary. They're not going there. So again, the question becomes, is there an ability to get a return on investment with that? But the market right now is pricing in an absolutely unlimited amount of investment in AI. And again, that all works great as long as they continue to hit those numbers. But I think there's a little bit of skepticism going on. NVIDIA hit their numbers in the markets the other day. We're kind of like, oh, okay, ho hum. And I think that ultimately, if you take a look at what is going on out there, and again going back to rational exuberance, I want to talk about a couple other things really quickly. Investors have built $337 billion in leverage market exposure through 2x and 3x leverage U.S. equity ETFs. That accounts for $209 billion 3x accounts for $209 billion of the $337 billion total, which means leverage is starting to explode in the markets. And it's rapidly jumped it started to jump really heavily in 2020. It tapered back when the markets pulled back after 2022. It has rocketed up again, especially going into 2026. The same time, we talked about this too, a lot of international investing has actually, I think you mentioned this last week, Kirk, they're focusing on the U.S. We're seeing more and more money, means they don't trust their own governments, they don't trust their own markets, they are investing in the U.S. markets. Actually, some data came out this week from Korea. They are seeing an astronomical spike in the number of liquidations of insurance policies. So this comes from their three largest life insurance, Samsung Life Insurance, Hanwha Life Insurance, and Kyobo Life Insurance, they saw policy surrender payouts reach 4.9 trillion won, which is 3.3 billion US in the first quarter. That's up 16.3% from the year earlier, according to the industry data. And what they're seeing is that cash is being taken and then dumped full port max leverage into the stock market. That suggests more policy holders are willing to terminate safety, trying to chase these higher returns, and that policy surrender value refers to the amount returned when the contract's canceled. But again, they're seeing the markets take off, and when you start to see these type of decisions, it kind of reminds me a little bit about the old saying of Kennedy's father, Joe. It's like I knew to get a little bit worried when I was starting to get stock market tips from the taxi driver. Well, again, we might be starting to see that when you start seeing the late money coming in and chasing these astronomical stock market returns. You see this much concentration, and then lastly, you look at the bond information out there, and you start to wonder: are we maybe in a long-term bond, the end of a long-term bond bull market, heading to a long-term? It could be a bubble. Are we looking at a long-term bond bear market? Those things all come together. In the head, it's going to be extremely dangerous for the markets. Are we there yet? No. But I'll add this last thing. Midterm election years typically are not great years for the markets. They tend to be a lot more volatile. And from that, again, going back to what you said, Kirk, I would start to not panic, but absolutely start setting in more cautious investing. Don't be chasing what you're getting in the news off those market returns every day. Last thing I'll say to this, I saw this the other day. It was great. One of the for do-it-yourselfers. When somebody posted, they said, the thing I always recommend to my clients is to put their money in Vanguard. And he said, not because Vanguard investments are any better. It's because their interface is so bad they'll never trade. So.
Oh boy, yeah. Well, let me share a few things because I've seen lately, and we can talk about chart crimes here. So this is one I've seen a lot over the last few months, and this is a chart crime. Basically, what they did was they took 1967 to 1983 in blue, and then they overlaid 2015 until today. Now, if you look at this, you might think, oh my God, inflation is going to go through the roof. And by the way, this is CPI. So a few things you need to know. First, the calculations on the CPI have changed probably like 3 or 4 times since 83. So the calculations are going to be different anyway. Secondly, could this happen? Yeah, it could happen. But what I remember last time was when this happened, it was because there was an oil problem in the Middle East, and there were gas lines where you had to wait in line just every other day or every other week to get gas. It was kind of a mess. We don't have that problem now, and in order for us to have that problem, our reserves, our oil and gas domestically would have to stop, which is not. So in order for us to get really, really high inflation like this, and by this metric, I would have to guess like 10% on the CPI. I don't see anything that's going to bring a 10% CPI. Am I saying it's not going to happen? No, I'm just saying I'm not seeing anything. So, the way I'm looking at this is, okay, so from now until 2029 or 28, late 28, according to this, CPI is going to keep going up. I think the likelihood of that happen is close to zero. It's non-zero, but it's close to zero. I don't think we're going to hit 10% inflation in the next 3 years. I just don't see it. I don't see anything that's going to cause that to happen. They might say, well, what happened during COVID? Yeah, it happened during COVID, but do you know why it happened? It happened because we printed a ton of money and gave it to people. Now, you could say, well, yeah, but we've printed money since the financial crisis. Sort of. So since 2009 until I forget when they kind of quote unquote stopped, but they had quantitative easing for the most part, and that more or less boosted the stock market. It boosted asset prices is really what it did. but it didn't get into the hands of consumers. Now, the one takeaway I have, because I've always been curious, they're printing all this money, but people aren't getting it. So why is it causing inflation? Well, it's causing asset price inflation. It's causing inflation with housing, with stocks, things like that. It's causing inflation, not with wages and not with a lot of other areas, but it was causing inflation in those main areas. So quantitative easing basically helped rich people. It didn't help poor people or middle class, generally speaking. So what happened since? Well, we had COVID. They printed a ton of money during COVID. They gave it to people. I mean, they had EIDL loans, they had the PPP loans, they had all sorts of shenanigans that gave money to people. Okay. Now, most people didn't get that. Most people, W-2 employees, they struggled because hopefully their employer paid them or whatever. But that was a struggle for a lot of people. But if you had a business, you could have pocketed a lot of money because that's the way the rules are written. It wasn't illegal. Some people did break the law, but most people did it legally. You could bank a lot of money, and all that cash, where'd it go? It either went down to pay down debt or it went to buy stuff. Now, this inflation that we saw it went up to like 9.2 or 9.3%, I think it was in 22, was off the charts. I mean, it was as high as we've seen in my lifetime that I remember. It was really high. And I attribute that to the fact that they gave cash to people. And when people have more cash, they tend to spend it. They don't save it. They don't pay down debt for the most part. They spend it. When they spend it, it boosts the price of goods and services. So everything went up in price and then it came back down. So that makes sense. Okay. So if I look at this, what is going to happen to cause them to print a ton of money? I don't see it. There's nothing on the horizon at the moment. Of course, we didn't see COVID either, so it could be wrong. But there's nothing on the horizon that's saying in the next 3 years, we're going to see the government printing money and giving it to people. I just don't see that happening, especially after seeing COVID. And they're like, well, we don't want to do that again. We had inflation. We had to fight that. No, maybe they do, but I suspect it's not. I suspect that's not in the cards. So I see this as a chart crime because this is what we call leading the witness. This is saying, hey, you see this chart? Well, look, there's a question mark, so we don't know what's going to happen, but there's also a red arrow that says it's going higher. I think this bunk. This is something that gets your emotions going. Just ignore stuff like this. I put this in the, isn't that interesting category, and I move on. I'm not spending a lot of time because what's going to happen is if this does start to go higher, I'll say, oh, well, what a coincidence. This is not, one does not equal the other. There is nothing here that says, well, because this happened, this is going to happen. They're totally unrelated, completely unrelated. We're talking about, 40 years ago compared to today. They're unrelated, right? Now, there might be similar circumstances, like we have a war in the Middle East right now, quote unquote, military conflict or whatever they're calling it. We have that going on, but it's not quite the same dynamics. Now we start bombing the crap out of them and their oil infrastructure. Yeah, we could see oil prices go a lot higher, maybe up to $250 a barrel. And yeah, we can start to see inflation go higher. It's possible, but I'm just not seeing it at the moment. So for the moment, until we see further evidence, you can just ignore this and pretty much anything like this, because all this is doing is causing you to freak out for no apparent reason. Okay. Now, let's see. We have.
Kirk, I just want to add something real quick on that. I mean, I think two things that are really important to note in that. Number one is if we do see massive inflation spike, it is going to stall the economy. That is going to suck the liquidity out. It has a lot of pressure to reverse itself from that. The second, also, we're watching the dollar trend right now. The dollar trend looks like it might be starting another at least cyclical strengthening. That does not a bode sign for QE. So
I'll call you out on that, Doug. The dollar, I think the dollar is a nonsense indicator that most people don't understand, and most people should just ignore it. The dollar has really gone nowhere for the last year and a half, and people see trends just like they see patterns in tea leaves. Frankly, there's no trend in the dollar right now, and what people claim will happen and what is happening are two different things. The problem with the dollar is the dollar is priced as a basket. So if you look at the Dixie, as they call it, it's priced compared to a basket of other currencies. It's compared to every other currency, major currency in the planet for the most part, right? You got the euro, you got the Canadian dollar, you got the pound, you've got all these different, you got the yen, you've got all these baskets that it's being compared to. And so if all of those are going down, the dollar goes up. If all of those are going up, the dollar goes down. That's how it works. It's not rocket science. So basically what that's saying is everything is kind of like maintaining equilibrium. So that's not a chart crime, but I would call stuff like that a chart crime because the dollar is a nonsense thing for most people, and the media loves to tout the dollar's going to zero. You know how many clients I had call me last year and say, "Oh my God, the dollar's going to go to zero. Oh my God, we need to get our money out of the dollar." Like, it's not going to zero. Like, and it's not going to go anywhere. Don't worry about it. Now, if you're traveling in the next month to Europe, well, maybe you need to, figure out what the dollar is. But frankly, if I look at the Dixie in the last almost 2 years, it's ranged from 100.5 to 95.5. But realistically, it stayed between 97 and 100 for the most part, 98 and 100. So it's a very small, you're talking about a 2%, 3% difference in your exchange rate. Whatever. If that's a real problem, if you're moving $1 million, okay, it might add up. But for most people, you're just going to Europe and you're spending 10 grand. That's, what is that? $300, $200. I'm not going to cry over that. And that's assuming that you know what you're doing and assuming you can time it perfectly, which of course you can't. So I would just ignore the dollar for most people when you're talking about indicators. It's a good thing to monitor, but it's not a good thing to use for trade because a lot of people tend to tie, well, the dollar's going up, gold's going down. I'm sure there's correlations there, but I haven't seen anything that's caused me to say, wow, I can make a lot of money off this. So for most people, it's a side note, just ignore it.
Yeah, I agree. I just think it's one of those indicators. And again, if it is starting to trend up a little bit or holding steady, it isn't even one where you can make the argument. And I think that's what your good point. It's like, oh, dollar's going to zero. Inflation's going to go through the roof. Get me out of the dollar. Well, okay, that's not true. And it didn't. And at the same time, right now with the dollar holding steady anyway, if you want to follow that data, it doesn't bode that inflation's going to go to the moon. So.
Yeah. So what's interesting now, I'm just sharing the Japanese bond yields Doug went over before. The thing about Japan right now is they're having a currency problem and a bond yield problem. And the problem that people have always had with Japan is they've had 0 to almost negative interest rates at some points. And there's what we would call a carry trade that people have been doing. And what the carry trade is you borrow in a cheap, you basically short a cheap currency, right? To buy you short a currency with low interest rates and you buy a currency with high interest rates. So effectively, an example might be if our treasuries are at 4% and the Japanese bonds are at 0, you would sell a bond at 0, so you're basically not losing any money, and you would buy a bond at 4%. So you're basically making a 4% spread, and the only risk is that it inverts, and then you lose money because the Japanese interest rates go up and the U.S. interest rates go down. That'd be the only way you lose money. Otherwise, you're sitting there earning 4% on borrowed money that you don't even have. Like financial institutions do this all the time. But what you need to see is this has been unwinding for the last 5 or so years because Japanese bond yields have gone from under 1% up to 3 to 4% for the most part. And those keep going higher. And here's the problem. Japan has a huge amount of debt. And so the higher the bond yields go, the less ability they have to pay for them. And this has always been the problem that people are worried about. They're like, well, if the carry trade unwinds and they can't control their yields, this could go up to 10 to 20%. And they're like 200 or 300% debt to GDP, which means that it's just going to bankrupt the country. I'm not saying that's going to happen, but I'm saying that's the risk that everybody's been concerned with for a long, long time. And I don't see how they're going to escape this, but for the moment, we'll just keep watch. And I will say in the equity markets, there's a lot of opportunity in the Japanese equity markets There's a lot of turnaround that can happen. I've loved value stocks in Japan for like the last 10 years. It's only the last few years they've started to take off, but they've been a good value for a long time. And even though they've gone up a lot, I still think they're a good value because there's a lot more value that can be created in the Japanese equity markets. But just something to keep in mind, even though the bond market's not looking good, the equity markets are actually doing okay. I think this is also a chart crime. I know Doug shared it, and it's interesting. And I don't know what the correlation is here. I just know that to me, this just looks like correlation, not causation. And there could be some causation, but when I see stuff like this, and I see charts all day long, and this is one of them, I see this as a chart crime. It's like, oh, you got some things that lined up, and there's somehow some correlation. Okay, well, we all know, because Doug shared this last year, there's a correlation between people who eat margarine in Vermont and people get divorced. Like, it's ridiculous. But the fact is, correlations exist. So is this causative or correlative? It's definitely correlative, but is it causative? I don't know. I'm not seeing anything that's going to cause a huge global financial crisis like in these times. So I just want to point that out because I see charts like this all day. I did want to pause on this though. Now, this is something we see occasionally, and it shows the rate of inflation for different goods and services in our economy. And it shows things that are more expensive, less expensive, and this starts from 2000 until more or less 2022. Now you can see things like TVs, toys, computer software, cell phone services. They've all declined in price over the last 22 years. Now I'm assuming this is inflation pegged because TVs have not gone down 97.7%. So I'm assuming this is pegged to inflation. But if you look at electronics like TVs, they've definitely, I wouldn't say they've gone down in value. I would say the price has not kept up with the value that's created. And so we used to have TVs that were these big boxes and there were projection TVs. Now we get LEDs. We got TVs. I don't know if you guys have seen this. There's TVs that literally are like wallpaper. It unrolls and rolls up and you can put on your wall. They're really expensive, so you don't see them very much. But I saw it online like last year and I was amazed. And you have something like that, it'd be like, wow, that should be like, 50 grand. Well, right now it's 10 grand and probably it'll be about $1,000 in a few years. So the price of electronics tends to drop quite a bit. I mean, the price of a computer since my first computer has always been around $2,000 for the same equivalent value, even though computers have been so much better over the years. It used to be, you have to one application on your computer at a time, and it was slow. Now you can have like 50 and it's fine. Like computers have improved so much, and yet the price of computers has probably dropped. It's been the same for the last 26 years, which means if you remove inflation, it's probably down like similar, like 80-90% in terms of similar equivalent value. So that's on the downside. I think we all recognize that that's happening, and certainly if you look at the other side of it, you've seen things like college tuition, college textbooks, hospital services are up to like between 163 and 227%. I mean, hospital services up 220%. I think they're kind of taking advantage of people, frankly. I could do a whole episode on experiences I've had. But if you look at the college is up quite a bit, it's almost 200%. Medical care, child care, you got all these things that are up quite a bit. And average wages are up 104%. So hospital services are now twice as expensive over the last 22 years than what your wages are. So the thing to keep in mind is that the middle class and the people who are poor are really struggling for a lot of these things. Yes, they're buying a lot of goods and services, but the stuff that actually matter, hospital services, college, childcare, are becoming more and more unaffordable for most people. So the thing to keep in mind here is that will inflation take off? We have higher yields. Do we have high inflation? Yeah, commodity prices have been going up. We'll next week we'll share again some of the prices of some of these things, but for more or less the prices of commodities are going up. Wages are not really going up that much. And, some of these services are going through the roof. I do think that if this war goes on for another 6 months or whatever, I do think we're going to see higher inflation. I do not think we're going to see 10%. We have seen consumer sentiment drop quite a bit. There's a bunch of things going on in the market. We had Nvidia this week come out, and the market it came out with good numbers. And the market didn't care. I think the market's extended right now. I think we're going into a holiday weekend. I hope everybody enjoys the holiday weekend, but I do think that the markets are extended. We are going into a soft period. As we shared earlier, there's a period of time where, let me see if I can find this chart. So there's a period of time where the markets are pretty slow, and there's a period of time where they're not. As of right now, we are entering into the slow period, and I do expect that even though we've seen the markets take off quite a bit, here it is. Here's the typical midterm cycles, the second year of presidential cycle. Here's the red line is every single midterm year in the last 72 years, and then the blue or green line is what we've seen pretty much this year. Now this is way above normal, way above average, and I'm not saying it's going to crash, but I could very easily see it going sideways until about October, which case I would expect it to start taking off again. Now, in general, a lot's going to depend on the war, but we had a good earnings season. That's been priced into the market right now. I think a lot of people are waiting. Next earnings season probably won't be as good because of higher oil prices. People are not pricing that in. Semiconductors are basically stealing the show. Everything else is going sideways. We'll share a lot of charts next week and show you what's going on. But for the most part, I would just be cautious. I would not be taking huge risks. Just because the market's taken off, I wouldn't just say, oh, it's good. In the first 4 or 5 months, it's up like 10%. It's going to go up like 50% this year because of that. I wouldn't draw that conclusion. I would just be more cautious. If you were lucky enough to buy at the bottom and have it today, and you're up 10% or whatever, have a party, and I would sit in the sidelines and just celebrate the rest of the year and do nothing, earn your 4% on your cash. But anyway, as we kind of wrap it up here, I'll hand it back to Doug, and have a happy Memorial Day weekend. Hopefully you're doing something fun. Hopefully you get some nice weather, barbecue, spend time with the family, take some time off, and we will see you all next week. Doug, take us home.
All right, sounds good. You know what? I'm gonna have a little fun today because Kirk, it's never fun. It gets a little stale, and if we're always agreeing with each other. So, so I'm gonna come back to the two things that there was a little pushback on. All right, first thing I'm gonna talk about is the dollar. All right, first of all, I make this very clear. Kirk is right about one thing. It is a terrible standalone prediction tool. Okay, correlations break all the time. You can find periods where the dollar rises and stocks rise, the dollar rises and inflation rises, the dollar rises while commodities ignore it temporarily. So if someone says the dollar always predicts markets, that is complete nonsense. But I will say there's nuance. Historically, the dollar absolutely has mattered as a macro pressure indicator, which is where I was going with that. Over long cycles, a stronger dollar has generally been associated with tighter financial conditions, lower commodity inflation, weaker global liquidity, and slower global growth. And a weaker dollar has historically lined up with reflation, stronger commodities, easier liquidity, and stronger risk appetite. The relationship isn't perfect day to day, but over time, there's some reality to it. And the reason's simple. The dollar is the world's reserve currency and debt currency. So when the dollar strengthens significantly, global liquidity usually tightens, especially in emerging markets and leveraged systems. By the way, we still get a lot of our goods from those emerging markets and leveraged systems. And that's why, and they also buy our goods. So that's why the major dollar spikes often do show up around the stress periods of, say, 2008, 2020, 2022. And it's not because the dollar caused everything, but it's because it reflected a tightening financial condition underneath the surface. So I guess I'd frame it like this. The dollar doesn't tell you exactly what the markets do next, but it can help tell you whether the global financial environment is becoming tighter or looser. And in a world built on debt and liquidity, that still matters. It is not a crystal ball. it's a pressure gauge, and ultimately don't trade the dollar alone, but I think you ignore it at your own risk. That's my take on that. Now, the other thing that I would go back to, I want to go back to that chart on the Japanese bonds in the U.S. Listen, I agree. It's mostly correlation when you look at that chart, but it does have some potentially meaningful signal underneath it. Now, the tweet is definitely overstating things pretty aggressively. The reality is the spread, because they're calling for doom and gloom, and of course they've narrowed. That's the thing that really creates these chart crimes, is they love to put a very strong opinion. Because I've been able to show this is happening. Of course, that gets you to click on the tweet. And everything's about clicks these days. The spread between the 30-year Japanese government bonds and 30-year U.S. Treasuries is not some magical crisis predictor by itself. The tweet absolutely cherry picks a few major crises and attaches significance to the pattern. A few important distinctions: correlation, yeah, somewhat. There have been periods where narrowing Japan and U.S. long bond spreads coincided with global stress. Again, just like I was saying with the dollar, 2008, 2011 to 12 with the European sovereign debt crisis, 2020 COVID shock. So visually, the chart pattern is real. Financial markets, though, produce tons of coincidental recurring patterns. The key question is whether or not there's an economic mechanism that explains it, and that's where we have to get nuanced. Possible causal mechanism? Kind of. Yeah, indirectly. Japan is absolutely, as you mentioned, one of the largest pools of capital. It still matters. Their institutions own massive amounts of U.S. Treasuries. They constantly arbitrage yield differences, hedge currency exposure, and influence global liquidity flows. And when the yield spread shrinks, it can signal things like Japanese yields rising unusually fast, or U.S. yields falling due to recession fears, changing FX hedge costs, stress in the global financial markets, or repatriation of Japanese capital. And these things can matter, especially today because Japan is exiting decades of ultra easy monetary policy. The yields are rising. Japanese yields are rising from historically suppressed levels. Global debt loads are enormous. Higher rates stress governments. They stress banks. They stress leverage trades. By the way, I just mentioned leverage trades are going through the roof. So yeah, a shrinking spread while both yields rise is unusual enough to deserve some attention. But this is where you have to be careful. When you jump from interesting macro signal to doom indicator, that's where, in today's language, slang, call it a cap. If this were robust predictive relationship, you'd expect repeated consistency across decades. Statistical significance, low false positives, a clear transmission mechanism. And instead, this is more of, hey, this has happened around some crisis periods, observation. That is not the same thing. A classic issue in macro finance, people confuse associated with versus predictive of. It's a huge difference. And what really matters more right now is this. Japan may no longer be able to suppress long-term yields the way it did for decades. And that matters because Japan has been a giant source of global liquidity, a buyer of foreign debt, an anchor for low global rates. Japanese yields normalize higher would mean Japanese money flow may flow home. Treasury demand could weaken. Global borrowing costs could rise. Leverage carry trades could unwind, and that is a legitimate macro concern, especially because the world is sitting at absurd debt levels. So deeper issue is in the chart pattern itself. It's what it may represent structurally. Bottom line, the chart, is real. It does have historic correlation existing. Causal claim definitely weak and overstated. Underlying macro regime shift in Japan generally important. And just again, treat this as a stress indicator, not as some sort of prediction. So I'm going to wrap it up as we close out today. Obviously, markets still climbing, AI spending still exploding, liquidity rising again. Underneath it, housing weak, consumer selective, credit stress building slowly, and even the global money system starting to show tension, and maybe significant tension. And that's why conversations like the dollar matter. Not because the dollar is some magic predictor, but historically, it's acted like a pressure gauge for global financial system. When liquidity tightens, pressure builds. When liquidity loosens, risk assets breathe again. And right now, we're living through both forces at the same time. a slowing economy, and a reflating financial system. It does create opportunity, but it also creates a potential for a lot of illusion. Markets can look incredibly healthy right before the underlying conditions become unstable, irrational exuberance. And that's why structure matters more than headlines. I love what you said, Kirk, about buying quality. There's a lot of quality out there. There's a lot of value out there right now. It's going to take patience. At Mergent Advisors, we don't really, I leave the stock picking to people like Kirk. They do a great job at being able to look at those trends. Absolutely, Kirk. You look at charts more than I do. When I focus, I help families step back and map the whole picture. Income, assets, liabilities, taxes, college planning, retirement planning, so that your strategy isn't just built around these temporary narratives or emotional market swings. The real financial confidence doesn't come from guessing what happens next. It comes from understanding how your plan's going to hold up if and when the cycle changes completely. And cycles, they always change. So if you want clarity about where you stand today and where pressure may build tomorrow, go check us out. We're redesigning our website really to clarify how we put together what we call the one plan that brings it all together simply in a way that helps you to be able to take control, put your financial house in order, and keep it that way forever. Because ultimately, you got to start the conversation, and the best investors, they don't ignore pressure gauges. They pay attention before something overheats. And with that, we'll see what happens over the next couple weeks, Kirk. Enjoy Memorial Day, everybody. Look forward to seeing you when I'm back here in about 2 weeks.
Awesome. Well, thanks for joining us, Doug, and thanks everyone for joining us as well. There's actually one thing I'll do it next time. We'll just wrap it up. It's a holiday week. Everyone wants to get home. Well, thanks everyone for joining us this week. Have a good long weekend and spend time with the family and take time off just to relax and come back fresh on Tuesday. So that's the show for this week. Thanks again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and podcast app of your choosing. You can also check out our show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a share rating and comment to the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling you products and services, so do not consider this advice. If you have any problems with the show, I blame Putin, so please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.